From a quiet operator in the shadows of Wall Street to the architect of one of the world's most formidable distressed asset franchises. Today, billions deployed across cycles, banks, mortgages, hotels, and hard assets on 3 continents. But the path wasn't what anyone expected. There's one decision John Grayken made that changed everything. Most people never see it coming. John Grayken's story begins far from the headlines he would later create. Public profiles describe an American-born financier who kept a low profile, even as the funds he founded became central players in moments of global financial stress. According to Forbes, John Grayken is the founder of Lone Star Funds and is an American-born Irish billionaire investor whose fortune comes from buying, restructuring, and selling distressed loans and real estate. The outlines are familiar to industry insiders. The details matter for understanding the empire. The early years were defined less by pedigree than by performance. Biographical reporting indicates a conventional path into finance, an entry into investment banking and real estate finance at a time when property cycles and credit cycles were still largely regional stories. What changed in the late 1980s and early 1990s was the geography of distress. The U.S. savings and loan crisis produced a once-in-a-generation liquidation of assets through the Resolution Trust Corporation, RTC, a federally created entity tasked with disposing of failed thrifts loan portfolios and properties. As reported by the Financial Times and other reputable outlets, this wave created a new class of crisis investors who could underwrite complex collateral, bid on bulk pools, and build platforms to work out assets at scale. Grayken's formative experience came inside that crucible. Multiple profiles, including the Financial Times, trace his early career to working with the Texas investor Robert Bass, where an affiliate called Brazos Advisors developed a playbook to acquire RTC assets in bulk. The mechanics were intricate: price pools of non-performing loans and real estate-owned (REO) structure financing against uncertain collateral performance, and build the servicing and asset management infrastructure to extract value loan by loan, property by property. This was not glamour. It was systems. The problem Grayken observed wasn't simply that assets were cheap. It was that institutions failed at scale when they lacked the time, capital, or skill to work through bad books. Value existed in the spread between forced sellers' needs and disciplined buyers' patience. But to capture it, a buyer needed a factory, data, services, lawyers, workout specialists, and the discipline to hold or liquidate based on math, not narrative. The pivotal moment arrived in the mid-1990s. According to Lone Star's own historical summaries and reputable business press, John Grayken founded Lone Star Funds in 1995, creating a dedicated platform to raise institutional capital and pursue distressed opportunities globally. He paired it with an affiliated asset management and servicing platform, Hudson Advisors, to handle underwriting, loan servicing, property management, and recoveries. This linkage, fund plus servicer, would become the backbone of the model. Skepticism was immediate and logical. Buying other people's bad loans requires more than money. It requires conviction that a buyer can do what a bank could not: analyze, restructure, foreclose, renovate, sell, or hold in ways the prior owner either couldn't or wouldn't. It also requires raising capital in size and convincing pension funds, endowments, and sovereign wealth funds that messy balance sheets can produce clean returns. According to Forbes and the Financial Times, Lone Star's early funds did exactly that, bidding on RTC pools, then using the same discipline to expand into Europe and Asia when their crises created similar liquidations. One personal decision also set Grayken apart. Public reports, including the Irish Times and Forbes, Note that he became an Irish citizen in 1999. That fact is often cited. Motivations are a matter of public speculation, but this script avoids conjecture. The verifiable point is simple. The founder of a major American distressed asset franchise became Irish in 1999, and continued to grow a global platform headquartered in Dallas with investments around the world. The stage was set: a buyer with capital, a servicer with systems, and a global field of sellers under pressure. But John Grayken was about to make a move that would change everything. Because crisis is local until it isn't, and the first investor to scale cross-border discipline wins the decade. The breakthrough wasn't a single deal. It was exporting a crisis-tested playbook into new markets, new asset classes, and new cycles, and institutionalizing the machinery to repeat it. The contrarian insight was straightforward to describe and difficult to execute. Distress is a recurring feature of credit systems. It migrates by region and asset class. If a firm can master loan-level underwriting, bulk pool pricing, and post-acquisition servicing in one country, it can take the factory to the next. According to the Financial Times and company histories, Lone Star did just that. After the USS and AMP-L cleanup, the platform pursued assets arising from the Asian financial crisis in the late 1990s and early 2000s, and later the global financial crisis in the US and Europe. Asia became a proving ground. As reported by the Financial Times, Lone Star acquired distressed assets in South Korea in the early 2000s, including a controlling stake in Korea Exchange Bank, KEB, in 2003, amid a banking system still recovering from the 1997-1998 crisis. The transaction and subsequent exit years later were highly scrutinized and controversial, drawing investigations and regulatory reviews. The record, as covered by major publications over the following decade, shows that the investment ultimately produced a sale and exit. This script does not adjudicate the controversies, only notes that they existed and were reported on extensively by reputable outlets. Japan provided another laboratory. Public reporting credits Lone Star with acquiring portfolios of non-performing loans and real estate from Japanese banks during the country's long workout period in the early 2000s. The principle was the same: buy complicated pools from institutions that needed to shed risk, then resolve the assets one by one through Hudson Advisors' servicing apparatus. In Europe, the global financial crisis replicated the early 1990s playbook on a different scale. Irish, British, Spanish, Portuguese, and other banking systems shed non-performing loans, NPLs, corporate credits, and foreclosed properties in bulk. According to the Irish Times and other national outlets, Lone Star was a buyer in Ireland after the crisis, purchasing mortgage portfolios and property assets as the state and lenders deleveraged. In the United Kingdom, reputable business press covered Lone Star's acquisitions of loan books from banks and its purchase of the Jury's Inn Hotel Group in 2015 for a reported price in the hundreds of millions of pounds, followed by a sale to Pandox and Fatal Hotel Group in 2017. Each move reinforced a pattern: buy at scale when sellers must sell, improve assets, exit into healthier markets. In the United States, mortgage servicing and origination became another vector. According to company and transaction announcements reported by CNBC and Rhythm Capital, formerly New Residential, Lone Star owned Caliber Home Loans and later sold it in 2021 in a transaction valued at approximately $1.675 billion. Residential credit, once a source of crisis, became a managed business line: originations, servicing, and securitization, within a broader distress toolkit. Financing mirrored the flexibility of the assets. Public records and market reporting show that Lone Star Funds raised limited partner commitments from institutional investors. Deal-level financing often combined warehouse credit lines, securitizations backed by the acquired loans or properties, and hedging to manage currency and rate risk in cross-border portfolios. The machinery was complex, but the principle stayed simple. Use LP equity to buy at a discount, finance prudently with collateral-matched debt, work assets through to resolution, return capital with gains, raise the next fund. The pattern that emerged was systematic, not lucky. Recruit specialized teams for underwriting and servicing. Build relationships with selling institutions and governments. Price risk through cycles, not quarters. Take heat during controversies with disciplined disclosures and compliance. Deliver outcomes to LPs that validate the model. Then repeat in the next region where balance sheets break. But success was about to attract unwanted attention, because the more distress a firm can process, the more it becomes a political, regulatory, and media target in every market it enters. Scale in distressed investing carries built-in friction, legal complexity, political scrutiny, cross-border compliance, and the reality that assets acquired from forced sellers are often attached to human stories. The challenges in John Grayken's empire came from three directions: market risk, regulatory scrutiny, and operational exposure. Market risk is the obvious one. Buying non-performing loans is a bet that collateral values will stabilize or improve and that workouts will produce recoveries above the purchase price plus carrying costs. In the late 1990s and early 2000s, pricing recoveries in Asia required underwriting in economies still healing from currency crashes and corporate defaults. In Europe after 2008, it required judging the pace of bank recapitalizations, the path of ECB policy, and legal regimes for foreclosure and restructuring that vary by country. Public reporting over the years shows Lone Star exiting portfolios with gains. It also shows periods where exits took longer than expected, and where asset sales faced community or political pushback. Distress is not tidy. Regulatory scrutiny is the quiet tax of scale. The KEB investment in South Korea drew intense investigation and public debate for years, including legal proceedings and media coverage about Lone Star's exit. Reputable global outlets, including the Financial Times, documented the arc of the deal, the allegations, and the eventual outcomes. The lesson for any crisis investor operating across borders is clinical. Returns come with process risk. Institutions must be built to navigate it. Compliance teams, local counsel, and patience become non-negotiable line items. Operational exposure is the third risk. The machinery that makes workouts possible, Hudson advisors and local services, must operate in multiple languages, legal systems, and property markets. Mistakes compound. Public records show Lone Star and Hudson operating through cycles precisely because the systemization of servicing is as important as the capital. Loan-by-loan resolution is labor, not a spreadsheet. Meanwhile, behind the scenes, John Grayken's personal profile stayed low, while his philanthropic profile rose. According to Boston Medical Center, BMC, and coverage in the Boston Globe, in 2017 John and Eileen Grayken donated $25 million to establish the Grayken Center for Addiction at BMC, one of the largest gifts in the hospital's history, with a mandate to advance research, treatment, and policy for substance use disorders. Public reporting across reputable outlets notes additional philanthropy in addiction medicine and public health. This matters because it shows a facet often invisible in deal histories, an effort to institutionalize impact outside finance alongside a career built on institutionalizing crisis investing. The challenge chapter of the empire is not a single headline. It is the accumulation of many: local opposition to foreclosures, parliamentary hearings about loan sales, lawsuits that take years to resolve, and the constant need to retain talent in a business where institutional memory is itself an asset. According to Forbes, Lone Star Funds has raised tens of billions of dollars of capital since inception. Keeping that capital at work through crosswinds requires something rarer than clever models: endurance. What happened next was not an escape from challenge, but a decision to double down on what the system did well. Retention anchor. The outcome was far from certain in each market, but what happened next surprised everyone by its scale, because the machine kept compounding while crises kept recurring. The empire is visible in fund sizes, geographies, exits, and a reputation for showing up where balance sheets break. According to Lone Star's public materials and reporting by the Financial Times, since its founding in 1995, the firm has raised dozens of funds focused on opportunistic and real estate strategies, with aggregate capital commitments reported at more than $85 billion over time. Assets span corporate debt, residential and commercial mortgages, real estate equity, operating companies linked to credit portfolios, and specialty finance platforms. The United States remains a core market. Post-2008, Lone Star acquired large portfolios of non-performing residential mortgages and re-established origination and servicing capacity through platforms like Caliber Home Loans. In 2021, New Residential Investment Corp., now Rhythm Capital, announced the acquisition of Caliber from funds controlled by Lone Star in a transaction valued at approximately $1.675 billion, as reported in company press releases and covered by CNBC. The sale illustrated a recurring pattern: build or buy a platform to work a crisis, exit when normalized markets reprice the asset. Europe provided scale in loan portfolios sold by deleveraging banks. Public sources in Ireland, the United Kingdom, Spain, and Portugal have reported Lone Star as a buyer of mortgage pools, corporate loans, and property assets as lenders cleaned up post-GFC. Transactions got branded with project codenames, large packages sold by nationalized or restructured banks. The mechanics were familiar: discounted purchase, heavy servicing through Hudson, monetization via restructurings, asset sales, and refinancings when borrowers recovered or collateral markets improved. Political scrutiny often followed, with parliamentary hearings in Ireland and press debates in the UK about foreign investors buying local debt. The model survived because the legal frameworks allowed it and because selling institutions needed it. Asia remained a second home for the playbook. Following the Asian financial crisis, Japan's long workout cycle and South Korea's bank restructurings created inventory for disciplined buyers. Public reporting credits Lone Star with major transactions in both markets. While the KEB investment drew the most attention, the broader pattern of buying non-performing loans and real estate in Japan and Korea mirrored what had worked in the US. The output: realized returns that justified the input, years of servicing and regulatory process. By the early 2020s, Forbes estimated John Grayken's net worth in the multi-billion-dollar range, often cited around $6–8 billion depending on market conditions, placing him among the world's wealthiest financiers. According to Forbes' 2024 listings, he is an American-born Irish billionaire whose fortune stems from Lone Star's funds, which have invested globally in distressed assets and real estate. The firm's affiliated servicer, Hudson Advisors, remains a core differentiator, thousands of employees across multiple countries managing the day-to-day of complex assets. Reputation in the industry pairs two traits rarely combined at scale: willingness to buy what everyone else is selling, and operational capacity to make those purchases productive. The feedback loop is self-reinforcing. When a crisis hits, the institutions that must sell want certainty of execution. Firms like Lone Star provide it. When portfolios go to market, the buyers who can underwrite in weeks, not months, win. When governments create auctions or set rules for deleveraging, the bidders with track records and compliance infrastructure get meetings. There is also the philanthropic empire, quieter but measurable. The Grayken Center for Addiction at Boston Medical Center, funded with a $25 million gift in 2017, according to BMC, has become a national leader in addiction medicine. Public reporting notes additional support for addiction research and care at other institutions. For a financier known for operating in crises, funding work in one of the century's defining public health crises is a pivot with symmetry. The compounding effect across markets is not merely financial. It is institutional. A firm that can price, buy, service, and exit distressed assets in the US, Europe, and Asia builds a muscle few others have. That muscle does not disappear when a cycle ends. It waits for the next one, ready to flex when forced sellers reappear. But here's what this actually means for anyone watching. The visible wins are auctions and exits. The real engine is a system for turning chaos into cash flow on repeat. A set of transferable principles explains how John Grayken built and scaled a crisis investing empire, and why it wasn't just luck, timing, or jurisdiction. System beats story. Distressed assets are not a bet on a narrative. They're an exercise in throughput. Lone Star's pairing of capital, the funds, with servicing, Hudson Advisors, is the secret engine. Without the factory, a bargain stays a burden. With the factory, a burden becomes a bond, a property, or a reperforming loan that can be held or sold. Buy from forced sellers, not just willing sellers. The spread exists because institutions must sell, due to regulation, liquidity needs, or strategic refocus. That is not cynicism. It is the structural reality of cycles. According to decades of financial press, Lone Star repeatedly showed up when banks, governments, and agencies needed bid-ask closure. The lesson is clear: price for the work, not the wish, and always ensure the legal and operating mechanics to finish what the seller could not. Underwrite legal reality. Distress is legal before it is financial. Foreclosure timelines, bankruptcy regimes, consumer protection rules, and tax treatment drive recoveries as much as collateral. Cross-border acquirers who ignore this get punished. The survivors starve for it. Public reporting on Lone Star's operations underscores the centrality of legal process management to every fund. Raise patient capital and communicate through cycles. This model does not fit quarterly optics. It requires limited partners who accept J-curves, high early costs, and back-loaded realizations. The reward is uncorrelated returns when executed well. Reputable press and LP reports over the years show Lone Star continued to raise funds across cycles, a practical endorsement from fiduciaries who inspect results. Diversify the distress. Not all downturns are the same. The S&L crisis was a US thrift meltdown. The Asian crisis was a currency and corporate debt event. The global financial crisis was a securitization and bank capital shock. The commonality is forced deleveraging. The lesson is to diversify by region and asset class, so the factory is never idle and the firm never becomes a monoline bet on one market's pain. Keep the operator close. In consumer credit, mortgage servicing behavior drives outcomes. In commercial real estate, property management and leasing matter. In corporate credits, operational turnaround separates recoveries from write-offs. Lone Star's affiliated servicer is not a back office, it is the front line. Builders in any industry can adapt this. Own the capability that turns inputs into outputs, don't outsource the part that creates value. Accept scrutiny as a cost of doing business. Crisis investors will be scrutinized by regulators, media, and communities. Public records around Lone Star's high-profile investments show that process takes time and energy. The lesson is to price that cost into every bid, staff for it, and focus on compliance and communication as core competencies. Anchor success in something larger. Philanthropy is not a substitute for ethics, but it is a signal of priorities beyond returns. According to Boston Medical Center and reputable press, the Grayken's gifts to addiction medicine aim at a crisis measured in lives, not dollars. That matters for legacy and for how an empire resonates outside the balance sheet. Why it wasn't just luck emerges in the repetition. A factory built and refined across 3 decades. A willingness to buy when others sell. The legal, operational, and financial machinery to turn inventory into outcomes. And a lineage of LPs who recommit because the model works. The critics often misunderstand the work. It is not about scooping up bargains in a fire sale. It is about being the last one in the building when everyone else has left, cataloging the shelves, fixing the plumbing, and reopening at a profit. What's required to replicate, at any scale, is less mysterious than it sounds. A small operator can apply the same spine, buy quality problems that others won't solve, control the capability that fixes them, price the work, and align capital around multi-year horizons. The inputs change, the mechanism does not. Software debt, operational debt, technical debt, each has its distressed equivalent and a version of Hudson Advisors that can process it. Modern applicability is stronger than ever. Regional banks face new pressures, office markets are in transition, consumer credit cycle with inflation and employment, sovereigns and agencies still dispose of assets in bulk. The geography changes. The factory remains. The lesson for the builder class is simple. During the next wave of forced selling, those who have a system will define the decade. But that's not the full picture. There is a pattern, hiding in plain sight, used by empire builders across eras to multiply wealth systematically, whether they buy factories, mortgages, or entire banks. It's what most people miss about how John Grayken did this. The Forbes 400 know it. They exploit it. They've built fortunes with it. It breaks down into 4 proven deployment methods that multiply wealth systematically. First link in the description, watch it next. 10 minutes that could change everything.